Well, welcome. A significant challenge for small to mid-sized firms, seeking to become employee-owned is having access to capital, as well as having access to business expertise. So it's my pleasure to introduce this session by Steve Buchanan at Mosaic Capital Partners. They're an employee-owned private equity firm that focuses on lower to middle markets. They manage a private equity fund dedicated to enacting ESOP transactions. They're able to provide direct capital as well as access to third-party capital. And they are true strategic partners, helping these businesses grow before and after the ESOP transaction, which benefits the seller, the employees, and clearly the communities in which these organizations operate. In this session, they're going to be giving you a case study of a firm that actually used a private equity to an ESOP transaction. So it's my pleasure to introduce Mosaic Capital Partners. Thank you.
My name is Steve Buchanan. I'm one of the founding partners of Mosaic Capital Partners. And we welcome the opportunity, appreciate the opportunity to participate in this year's conference as an advocate for employee ownership. Mosaic Capital Partners is a private equity fund manager headquartered in Charlotte, North Carolina. And we function as a financial sponsor in the lower middle market. However, we go to market with a very different strategy and with respect to delivering liquidity events to the sellers of privately held companies. And our strategy combines the best attributes of traditional private equity investing with the very unique and powerful impact that employee ownership can have via an employee stock ownership plan, an ESOP. Today, we're going to talk about and illustrate for you how we execute our transactions by walking through a case study of one of our existing portfolio companies, a firm called Sayers Technology. In Sayers, as we do with all of our employee-owned buyout transactions, we've utilized a fairly traditional private equity leveraged buyout style of financing for our transactions. And in this case, we used a traditional senior bank as our senior lender, an institutional third-party capital provider to provide the mezzanine or subordinated debt tranche. And then we at Mosaic, serving as a financial sponsor, provided the rest of the capital necessary to create a liquidity event for the sellers. And we call the security that we invest in structured equity. And so today you'll hear from the CEO of Sayers, Chris Callahan, as well as representatives from the other capital providers that worked with us to deliver this transaction and compete for the transaction in the marketplace. We at Mosaic are huge advocates for employee ownership and believe a key component to expanding the participation of employee owners is access to capital. And what we want to demonstrate today and inform the attendees of today is that there is access to third-party capital, that our transactions are viewed by third parties in a similar way as they view other financial sponsor transactions, but that there is a unique component to our strategy, which is our deep knowledge and experience working with an employee stock ownership plan as the buyer of our businesses. And when we complete our transactions, we provide capital, but our businesses are 100% owned by our employees as we close. So we're going to share with you the interviews from the folks that were critical in our ability to deliver this transaction. We again appreciate the opportunity to speak with you today. If you have questions before or after the conference, please forward them to the folks at Rutgers and we will respond to them and welcome the opportunity to continue to educate the marketplace on how third-party capital can facilitate the growth of employee stock ownership plans across our country. Thank you for your time today. We greatly appreciate it. So we're going to kick off our Mosaic and Sayers case study. Today, we're joined by Chris Callahan, who is CEO of Sayers Technology. Chris, thanks for joining us. We appreciate your time today.
Yeah, thanks for having me.
Maybe a great place to start, Chris, is introduce yourself and Sayers so the conference attendees have a feel for who you guys are and what you do. And then maybe segue into a discussion of what led your Sayers to be in market looking for a change of control transaction in the first place. And then maybe share the perspectives that you and your management team members brought to that process.
Sure, be happy to do so. So my name is Chris Callahan. I'm the president and CEO of Sayers Technology Services. I've been in this position for over 7 years now, and with the company for a total of 14 years this fall. Sayers Technology Services, we're a value-added reseller and IT consulting firm headquartered out of just outside of Chicago. We focus on helping customers with large infrastructure purchases as it relates to servers, storage, and networking. We also help companies through our cybersecurity practice help protect the data and help them manage data growth. We were owned by private equity from March of 2015 to about March of 2018. During that final year of our previous private equity owner, we started a sale process. The stated goal was to sell the company within 3 to 5 years at that time. And about almost to the date, or month to the date of the 3-year mark, we were sold to Mosaic Capital, and they brought the ESOP philosophy and the capital to convert the company to an ESOP at that time.
I know, Chris, when you guys and your previous owner had done the process which led you to being sold to Virgo, you folks had actually thought about an ESOP. And what led you to that?
We did.
Request, and why didn't you pursue it then?
Yeah, it's a great question. We did. We looked at a lot of avenues to get the founder owners a proper exit for the work that they put in the 20 years leading up to that point. We looked at the ESOP. At the time we looked at it, there was a pretty steep learning curve in terms of the compliance, the regulation, and also the significant cost. And we also didn't feel like it would provide the liquidity event that the founder owners were looking for as it relates to their exit. And then we kind of honed in on more of a sale process to either a strategic or a private equity firm. And then we ultimately ended up going to the private equity route.
And as managers that have managed a business under an entrepreneurial style, private ownership, and then 3 years under working with private equity, what kind of perspectives or thought processes did you and your fellow management team leaders have in the process, and what things were appealed to you, and what did you want to try to achieve?
Sure. I mean, I think first and foremost, we have a much better disciplined company, especially as it relates to investment decisions and timelines. One of the challenges of running a company that is very closely and privately held is access to capital for investments in order to grow the business at the rate to which the management team felt that we could grow the business. Having private equity capital infused in a formal board of directors streamlined the process for us to make investments, work on strategy, and so that we could then build a business case, have access to those funds, invest that back in the business, and then grow the business pretty rapidly.
And what about your thoughts or your fellow leaders' thoughts around an ESOP, based on what you knew about it prior to meeting us?
Yeah, the ESOP, we felt, philosophically from the beginning, even back 5 years ago, was a very interesting and probably the right capital structure for a company like ours. We have very, our philosophy as it relates to our customers and the technology partners whose solutions we sell to our customers is very long-term focused. Being owned by straight private equity, the first time around was a challenge. As a 3 to 5 year investment time frame is stated from the very beginning, we had a lot of short-term pressure, especially on a quarterly basis, in order to hit very aggressive financial metrics so that we could position ourselves for a sale. The ESOP structure has allowed us to do many things. One, in terms of company culture, we've always had a very close-knit family culture. The ESOP benefits solidified that in terms of helping our employees understand that their contributions to the growth of the company, that they can now participate in the upside of that as the company grows and does better, so do their financial situations and their benefit under the ESOP. And so having Mosaic as our partner through this ESOP journey has been tremendous from many standpoints. first and foremost, the education in terms of what the pros and cons and the benefits are of having an ESOP benefit in place for employees. Was very valuable in the beginning, helping us get our heads around it. But equally as importantly is providing the capital in order to provide such a benefit to our employees. And so now we've always had that entrepreneurial aspect across companies, but the ESOP really solidified that. And so having folks think in terms of an owner of the company, looking at where they can drive costs out, where they can make things more efficient, and everybody all rowing in the same direction, trying to improve the financial results of the company.
You know, Chris, you're in an area that's highly competitive. The IT space is growing. The demand seems ceaseless. How have you used the existence of your ESOP to help you recruit and retain employees?
Yeah, it's a great question. It's been very helpful. One of the things we compete for are engineering talent, whether it's in server storage and networking, but especially cybersecurity. The talent gap is real, and it's highly competitive in order to get the top talent that we need in order to do our job to help advise and educate customers on what the right solutions are for them. And we compete with publicly held companies. We compete with startups who offer benefits like employee stock option plans, public stock, purchase programs, and things like that. And the ESOP gives us that tool that we need and that benefit we need to help even the playing field, so to speak, for that talent.
Yeah. You know, as we talked at times about one of the unique characteristics of an ESOP buyout as we structure it. So your business is 100% owned now by your ESOP trust. One of the benefits of that is tax driven. So the company is now a tax exempt entity. You know, you guys had a fantastic 2018 and 19. Talk about how that tax shelter had incremental value to you when in a situation where the company is really performing very, very well.
Yep, that's a good question. I mean, the tax, you know, we refer to it as tax leakage. So dollars or cash or real money that instead of investing back into the business, and for us, it's typically into hiring more people and creating more jobs. It's a strong benefit. We used to, obviously, as a privately held company, our tax leakage was significant, especially in the years we were growing and generating significant amount of cash. And so having the ESOP tax shelter and the benefit of that, instead of paying that money in terms of taxes, we can then redeploy that capital to either pay down our existing debt at an accelerated rate or reinvest back into the business in terms of hiring more people.
And in your case, during 18 and 19, you guys really pursued both of those avenues simultaneously.
We did, yeah. We were able to take an aggressive stand, basically skip ahead 2 to 3 years in our debt reduction strategy, and then also hire close to 30 people over that 2-year span. Excellent.
I'm kind of curious, what has been the reaction from your employee base? Obviously during 18 and 19 when things were doing well, and then obviously, you know, everyone's had a challenging 2020. What impact do you think being employee owned has had in both of those situations?
Yeah, I mean, it's helped tremendously from the culture perspective primarily, but also, you know, people, when we come out and you inform the folks that we are now an ESOP, there's a lot of questions and there's a lot of education. And you know, we're very appreciative to you all for helping us educate our employees through all company meetings and in terms of what that means and how that benefit is described and how that mechanism works for their benefit. So the year one was a lot of education, a lot of questions. We experienced phenomenal growth from 2018 when we introduced the ESOP to 2019. And so when we issued the 2019 benefit statements, the reaction was overwhelmingly positive. People could actually see real numbers on their benefit statement. And it was very exciting. And, you know, we talk about breaking records every quarter and how the company's doing better and better. And then when they get their own statements that show them how that growth and how that has really impacted their financial life, it's very rewarding and very positive. And so that's been a very good aspect of it. And then in challenging times like this year, you know, where, you know, the business isn't going to be as strong as what it was in the prior years. People understand that. And they understand that, as stocks go up and down, so the valuations of companies in an ESOP, as we do well, the performance is seen through the benefit statements. And when a company doesn't have as good as the year before, they expect that valuation to be challenged. So, I think that everybody has a good understanding of it now. And it'll be something that we'll just, continue to rally around and build that statement back up together.
Sometimes folks ask questions, Chris, is being in an ESOP structure, being owned by an ESOP in our kinds of situations where Mosaic is a outside additional capital provider, have you found that your horizons are restricted or limited, or are there any downsides to you from, as far as you're concerned, from being in an ESOP ownership?
No, I mean, just the administrative aspect, but that pales in comparison to the upside benefit of it. And what I mean by that is the cost to administer the plan, which is really negligible at the end of the day. But no, we haven't seen that at all. It's helped solidify the culture of the company. We have a great partner in terms of you all helping us with access to capital as we look at potential acquisitions and things like that. So from our aspect, it's been a very positive experience, and there hasn't been anything that's limited us in terms of pursuing our growth strategy.
Well, thank you for that. And just so for the folks that are conference attendees, at Mosaic, one of the things we do as we're talking to new prospects, either firms that are going through a change of control transaction process, and the management teams at those firms, we make our CEOs in our first fund, like Chris, available to other managers. And Chris has been very generous in speaking with folks, other CEOs who are trying to understand and go up the same learning curve he and his team went up when they were, transitioning in the ESOP ownership. And so Chris has been very kind to help us there in multiple cases. And I will maybe go ahead and offer this up. If there's folks that are listening in today who have questions about what we do and how we do it, or what it's like for someone like Chris to have transitioned to an own ownership, please don't hesitate to reach out to us. We at Mosaic would be happy to answer any questions you might have. But we also realize that it's very powerful for leaders to speak to other leaders. And so Chris has helped us in the past. I'm sure he might help us in the future. If anyone here today, has specific questions, we'd be happy to answer them in any way that we can. And with that, Chris, thank you for your time today. Greatly appreciated. Well, hopefully your family continue to avoid any COVID ramifications.
Yeah, thank you. I appreciate it. Happy to help.
Thank you. Appreciate it. This afternoon, I have Jim Rolfe and Ross Cohn joining us from CIBC Bank. As we've talked about our Sayers case study, CIBC was a key player in our ability to execute that transaction. And so I wanted to have Jim and Ross join us to share their views and some of their interesting insights about the transaction itself, not only the particular credit, but also the style of transaction that we are executing here at Mosaic in the context of executing these, what we call employee-owned leveraged buyout transactions. So maybe I'll start by letting Jim and Ross introduce themselves and introducing CIBC. Share with our conference attendees, what it is, what kind of transactions they're working on, what kind of portfolio they're building for their bank in Chicago. And then we might segue into a conversation about Sayers and what about it appealed to you guys and how you viewed our style of transaction relative to maybe some other leveraged buyout style deals that you guys have participated in. So Jim and Ross, let you guys take it off from here.
Great. Thanks, Steve. I'll introduce myself and then I'll let Ross have the floor. My name is Jim Rolfe. I am a managing director and market lead at CIBC Bank here in Chicago. CIBC is the fourth largest bank in Canada. Chicago is their US headquarters. I am part of a group within what's called Illinois Commercial Middle Market Banking, which caters to primarily privately held second, third generation family owned businesses. We work with a lot of private equity firms and sponsors, providing credit and all the ancillary banking services, such as treasury management services, derivative products, capital markets products, et cetera, et cetera. Sears has been a longtime client of ours. We've been through 2 transitions with them, once when they sold to private equity in the first place, and then a couple years ago when they decided to convert to an ESOP. So that is my background, and Ross, take it away.
Thanks, Jim. I'm Ross Cohn. I work in CIBC's middle market group. I've been here for 7 years. I focus on new business development and portfolio management. Our portfolio of deals includes a nice, healthy mix of leverage buyouts, traditional middle market deals, as well as employee-owned companies, Sears being one of them. And it's been a really interesting year for sure, but certainly we've done everything we can to get through these challenging times together, and working in partnership with Sears has been a nice highlight of this past year. We were introduced to Mosaic in the conversion of the company to the ESOP, and really it's been a nice, pleasant surprise for us to work with the sponsor in the conversion of a company to an ESOP, having their expertise as it relates to the employee, the ESOP issues, the intricacies of an ESOP, which are so unique. Having a firm that has a lot of experience in this, as with multiple seats on the board as a sponsor, has really been a nice benefit to us.
Well, awesome. Ross, Jim, thank you for that. I know you mentioned that, and we are aware that you folks were sort of the incumbent bank. Talk about the sort of capital structure that existed when they went through their existing or their previous private equity transaction, and then also where you folks played in the transaction that we put together for the ESOP buyout.
So we were introduced to Sears. They were a local company first and foremost, and we knew them from our LaSalle Bank days, which is where a preponderance of our professionals came from. After the purchase of Bank of America by LaSalle, we moved over to the private bank, and then we sold the private bank to CIBC 3 years ago. But we knew Sears, and we were introduced to the transaction actually by a mezzanine firm in Pennsylvania called Marion Investment Partners, who I had worked on several other deals with. I had a very good working relationship with them, and they said they were looking at this opportunity for Sears. Could we put a deal together and walk down the aisle with a private equity firm out of Texas, out of Austin, called Virgo. We met the Virgo guys. We liked them, very smart, and we came to an agreement on a transaction. That was what I would call Sears Phase 1 or 1.0. Along the way, some of the principals really felt compelled and felt a responsibility to really reward the employees that helped them build Sears to where it was. And they started toying with the idea of an ESOP. And to that extent, we got some other professionals involved. At one point, one of the principals was willing to do it on his own. I'm glad he didn't in retrospect. But we did get to a transaction, obviously, with Mosaic, and it's turned out really, really well. Ross, I don't know if you have other things to add to that.
Yeah, I would just say in the first iteration of our relationship with Sears under traditional private equity ownership, as Jim alludes to, there was a layer of senior capital, which was us at CIBC, a layer of traditional mezzanine capital, and then pure cash equity behind it. In round 2, given the company was converting to an ESOP, it was important that to allow it to maintain its 100% S Corp status, that all of the capital is in the form of indebtedness in some fashion. So certainly it's unique in what we look at from a traditional buyout perspective, but there's 3 layers of capital. There's CIBC senior tranche, a traditional mezzanine debt tranche, and then what we refer to as a structured equity tranche that pays a current cash pay with it. It's certainly a meaningful amount of total debt. However, given the dynamics of an ESOP, specifically 100% S Corp ESOP, Sears is a tax-exempt entity, and that's key in our underwriting of the deal, because it frees up a significant amount of free cash and allows the company to very quickly delever. That was certainly a critical element to the completion of this deal. Yeah,
you touched on a couple of interesting points there. one question I'll ask. So as a senior lender into this leverage buyout style transaction, you mentioned that you had already, as Jim put it, walked down the aisle with Sayers once before when they did their original private equity transaction with the folks at Virgo. And then we brought you another chance to participate. How did you, from a senior lender, from you as a senior lender's perspective, how did you view Mosaic as compared and contrasted to Virgo in terms of the, are we a financial sponsor in your mind, and why is that important to you?
Well, I think whenever you're dealing with an ESOP, you've got a unique set of circumstances to begin with. And Mosaic certainly has a ton of background and experience in working with ESOP-owned companies and understanding the structures. Where I have found in my 10 plus years of working with ESOP-owned companies and structuring deals is the deals that you have challenges with at the onset are having professionals who don't know what they're doing in the ESOP space. That was absolutely not the case here. And that's why I'm insistent that whenever we're looking at an ESOP transaction, that we're working with professionals who are dedicated and committed to the ESOP space. And Mosaic is certainly, in that discussion. And even more so when you encounter challenging times like we've just, realized over the last 9 months. I can't imagine a more collaborative group in stressful times that have been able to work through it. In many cases, we didn't have to ask to do some things. Both Mosaic and the company initiated those transactions, whether it was cutting their own salaries, turning their interest off for a period of time, et cetera, et cetera. That's what you want with partners, and I think that's really important. And I think Mosaic is a private equity firm in the sense that it's making investments and it's looking for a return, and that's fine. But it does have that quality of certainly understanding what ESOP ownership and ESOP structures are all about.
Yeah, I'd echo Jim's thoughts, but I'd also add that in traditional ESOPs, you tend to see when you have a privately held business where the majority shareholders are taking seller notes, they tend to want to extract as much cash from the transaction as possible. So implement as much senior leverage as possible in an effort to take as many chips off the table, if you will. That was certainly not Mosaic's approach, and that was highly appreciated by us. I think that as a sponsor, Mosaic had a strong incentive and desire to ensure that there was an appropriate amount of senior leverage on the company to ensure that it could withstand times of stress. And from a diligence standpoint, I'd say Jim and I were really encouraged that a lot of the things that Mosaic was digging into as a sponsor were the same things that we dug into on the front end when we embarked on a relationship with Sayers. So that's been key to us, and clearly they understand the business very well, indicative of any type of buyout that you'd expect from a sponsor under a traditional buyout or an ESOP.
Ross, you touched on something earlier, which I think is a key element of our strategy and a key element of why we can make our employee-owned leveraged buyout transactions work, both for us as a capital provider, as well as for third-party capital providers like yourselves, and as a powerful tool for creating value for the employees, which is the fact that by using this 100% S-Corp ESOP structure, our companies are essentially tax exempt from federal and state income taxes. I know we were very fortunate, thanks to the great leadership at Sayers, that in the first couple of years post-closing, the company really outperformed expectations. Talk about how, in a case where a company is outperforming, how and why that tax shelter can be sort of an accelerator to deleveraging and creating value.
I mean, look, the cash flow is the cash flow. And if you're not using that cash to pay taxes, you've got one of two things to do with it: invest it or reduce debt. And so it allows us as senior lenders to either shorten our maturity or have a more rapid amortization program, or actually put a little bit more leverage on, because we know that the cash flows are enhanced by that available cash flow.
Yeah, absolutely. Go ahead. I'm sorry. Go ahead, Rob.
I would just add to that. Certainly, the magnitude of the increased cash flows from our base case in underwriting the deal was substantial, and allowed for some more rapid deleveraging in the first year. But it also allowed the company to make key investments in personnel to accelerate its growth. So those dollars wouldn't necessarily be available under a traditional buyout where there's a meaningful amount of earnings that's taxed.
And you know, the other thing that, you know, when we think about capital structure, when we're talking with firms like Sears, certainly at times they want to take chips off the table versus, you know, via a dividend recap. And we did do that in phase one, but they were also very cognizant that, you know, capital is precious. And if they wanted to do acquisitions down the road, they can't take all their chips off the table, and they have to preserve some of that capital base, because they were looking at acquisitions, and, you know, more than just one. So I think they were very mindful of it. And so when we did the dividend, it was, you know, appropriately sized, and it wasn't maxing it to the limit, because they had that acquisition concept in mind.
Yeah, I think that's a great reflection on the leadership over at Sayers. We have a great team there. Chris Callahan's very impressive, very seasoned, and the team there, as you mentioned, Jim, has a great appreciation for the balancing of appropriate levels of leverage, reducing cost of capital, yet also giving themselves optionality in the case of looking at acquisitions. By not leveraging to the max, you are essentially creating some a capital availability to go do things strategically that can help create equity value. And our team there is intensely focused on building equity value for themselves and for the rest of the employees over at Sayers. And that focus on their part has manifested itself in really multiple ways. And you just touched on a couple of them.
Yeah, I also, Steve, I'm sorry to interrupt. I also don't want it to get lost in the conversation that it meant a lot to see Virgo stay in. I mean, they're a private equity firm, and as you know, most private equity firms are out in 3 to 5 years. They saw the value, and they said, we have another chance to continue to support this, and them staying in demonstrated their commitment too.
Yeah, well, I think again, these are all great reflections back on the Sayers team. You know, I say to the Sayers guys that they, because of their approach to the business, their professionalism, their transparency, they are very proactive with you folks, always telling you what's going on. You don't ever have to ask them. As a result of that, you know, my metaphor is that they built up some credit in their account with you and our other outside lenders. And you never can tell when that's going to come in handy. And this year has been a year where that kind of credit, that kind of confidence in the team is really, there's no way to put a value on it. And that's manifested itself in lots of ways. And you guys have been great to work with in this transaction, not only when they were knocking the cover off the ball, but now when they've been thrown a bit of a curveball as a result of COVID. So I just wanted to tell you thank you for all of that. It's been a joy working with you, and thank you for joining into our conference today. And if folks, I would encourage anyone who's attending today virtually, if you have an opportunity to work with a business in the Chicago area, we really could not recommend Jim and Rolf and CIBC any more highly. And we hope that this will result in some business for lots of folks going in both directions. So for that.
Well, thank you, Stephen. And, you know, we do ESOPs around the country. So we're not just limited to Chicago, because ESOPs are a structured specialty, not a geographic specialty. But, you know, if anything that we've learned over the years is relationships do matter. And I think you can ask the Sears guys that when the chips are down, you know, who do they turn to, and who do they know that can get a transaction done? And it was guys like you, it was guys like Tia, and it was guys like us. So I still believe in that old fashioned, you got to know who's on the other side of the phone call when you're in a stressful situation, and know that they're going to be there for you.
Absolutely. And you guys have demonstrated that in both action and deed. So thank you, guys. Thanks for joining today. And we appreciate your support and helping us with our little Sayers case study.
No, thanks for having us. Steve. Really appreciate it.
Okay, guys. Thanks a lot. Take care. So want to welcome another participant in our Sayers case study, and it's Dodson Worthington, who is with Churchill Asset Management. Dodson, welcome. Thanks for joining us. We appreciate it.
Yeah, thanks for having me.
Well, thank you for joining us. Maybe a good start will be let you introduce yourself and Churchill to the conference attendees. I know you folks have had a few name changes in the last couple of years, so bring everybody up to speed on who you are and what your group is up to.
Yeah, sure, Steve. Thanks for having me. Great to be here. So I've been with Churchill since 2014. And at the time I joined, it was TIAA. And then we changed names to Nuveen. We acquired Nuveen from Madison Dearborn and rebranded all of our asset management as Nuveen. And then we acquired Churchill, kind of a senior middle market lender, and then spun out our private equity and junior capital team into Churchill. And so now Churchill is an affiliate of Nuveen, who is owned by TIAA. So the team and the strategy have stayed the same since I started, but our name has changed a couple of times, so can create a bit of a story in the market. So happy to tell it, but I'll just kind of talk a little bit about our strategy, at least on our team. So I'm on the private equity and junior capital team within Churchill. Portfolio is roughly $12 billion. About $10 billion of that is fund commitments. Primarily U.S. middle market funds, have about 100 GPs that we manage in that portfolio. And then we also have a very active direct lending business, mostly alongside those GPs in junior capital securities. And then we also do equity co-investments alongside those GPs. So have separate kind of junior capital portfolios and an equity co-investment portfolio, which is all underpinned by a pretty robust fund investing program.
Interesting. So fundamentally, you folks have used your relationships with GPs managing private equity funds to then generate direct lending opportunities for you guys to deploy incremental capital into the lower middle market.
That's exactly right. So we want the fund investment, to stand on its own and have merit as a differentiated fund strategy that's going to generate compelling risk-adjusted returns. Kind of our hurdle, think of it kind of in the, 2.5 gross MOC, kind of low 20s IRR. That's our target, and so, the fund investments have to stand on their own. But yes, we are trying to be full service capital providers, partners to these funds through providing, direct capital in some of the individual companies that they do as well. That's exactly right.
And typically the capital you're providing on a direct basis is traditional, so subordinated mezzanine debt tranches.
Exactly. A lot of that, it's really anything south of the senior or south of the first lien. And that's one of the really interesting things about the mandate is that we can structure it really however we want if it gives us the kind of risk-adjusted returns that we want. So yes, a lot of times it's mezz, sometimes it's second lien, sometimes it's a holdco PIK note or structured capital. So it can take any number of forms, but that's the general idea. Yeah, kind of sub-debt mezz is a big part of that.
And prior to directly getting involved in Sayers, had you folks had much exposure to an employee ownership style structure, or had you looked at it before?
Not a lot. Sayers was really kind of our first big foray into that strategy. And then investing in Mosaic kind of was our, kind of first fund investment in that strategy. I think we've certainly been hearing more about it. And I think people are realizing how good the model is in fostering alignment between employees and management and ownership. And so, I bet we're just going to start, keep hearing more and more about it. But yeah, our first step into that world, I'd say in a serious way, was the Sayers transaction.
Interesting. And so obviously you folks are very experienced in providing capital in traditional private equity style leveraged buyout transactions. Ours are similar, but a little bit different for some of the reasons we've talked about, taking advantage of some of the tax benefits that are created by being ESOP owned. As a capital provider, did you look at it? Did you look through a different lens, or think of our deals differently than you did with your other traditional PEG GPs?
Not really, Steve. We looked at it through, I'd say, a pretty normal buyout lens. I mean, there's some idiosyncrasies about the deal, given that it was going to be sort of an ESOP structure post-close, but we did diligence in the same way. We did diligence on the space, the Sayers transaction. It was an attractive tech space, kind of enabled benefiting from kind of the cloud migration that we're seeing. And Sayers had a good differentiated position in the market. We did diligence on the management team. We did diligence on the organic and inorganic growth levers. And so, I mean, we really, we went to a management presentation. We, evaluated the company. We evaluated the markets. Frankly, we evaluated the way that the Mosaic team was viewing the investment and talking to management, and kind of did some work on their knowledge of the space as well. And at the end of the day, I think, we came to a structure that was pretty comparable to other buyouts. I mean, when you look at kind of loan to value, kind of percentage through enterprise value of our mezz piece, it was pretty similar to other deals that we look at. As you mentioned, the fixed charge coverage here was really strong on our mezz security. We liked that a lot. But no, I wouldn't say we really looked at it much differently than a normal deal.
Yeah. So I guess it's safe to say that for you folks to be interested, you folks are biased towards having a financial sponsor involved in your transactions. And so,
yeah,
like
absolutely.
the fact that you're a debt provider, we don't own majority control of the company, which is the way traditional PEGs are structuring their buyouts. You folks were still comfortable that that Mosaic was, and it is, and was going to function as sort of the sponsor for the transaction.
That's exactly right. We won't do, or very rarely will we do a deal that does not have a sponsor that we know in it. We want somebody at the helm who we know, who has expertise in the space, who can influence decisions at the board level. And so yeah, that's really important for us. And so in this situation, we very much felt that Mosaic was playing that role and would play that role going forward.
Yeah. One of the things we've talked about with the other constituents, including Chris Callahan, is for the value of the tax shelter. That's a unique aspect of our transactions. None of the deals I expect you're providing capital to have that benefit. How did you guys look at that in terms of get comfortable with that in terms of the fact that we as structured equity providers, we're going to take a minimum amount of interest payment early on in the life of the investment?
Yeah, I mean, just when a company's not paying or paying minimal cash taxes, it's a very powerful thing for the credit profile. And so, I mean, we look at, I think similar to you guys, we look at leverage statistics on a deal, but when we're lending to a company, we really want to know what the fixed charge statistics are. And because, of the way that your deals have a tax shelter, specifically this Sayers deal, it got us comfortable that there was a lot of cushion beneath the base case for our credit to still be solid, and our mezz security to still be solid.
Yeah, we talked with Chris earlier. We were fortunate that Sayers performed extremely well in 18 and 19. And one of the byproducts or ancillary benefits of being tax sheltered is, all of those excess cash flows were then available to either reinvest or delever. And in Sayers' case, they did so well in 18 and 19 that they were indeed aggressive in deleveraging the balance sheet, which sort of gave them an incremental margin or cushion for error as we all went into the challenges of 2020.
Yeah, and it's fairly rare that we get early payments back on our mezzanine. And in this situation, they were able to prepay some of the mezz, which was, I think, a great, we were certainly happy to get a return of capital, earlier than we expected. And I think it was helpful from a capital structure standpoint, cost of capital standpoint for the company. So yeah, I mean, we definitely, we witnessed kind of the power of the tax shelter in this deal.
Absolutely. Well, Dodson, thank you for your time today. Greatly appreciate it. Obviously, we at Mosaic greatly appreciate your support of us and appreciate the support you've manifested through Sayers. It's been a joy working with you. We look forward to continuing our relationship with you guys, not only in Sayers, but in other deals that we hope to bring to market. And just appreciate your support, and thanks for joining us today.
Yeah, thank you so much, Steve. Looking forward to keeping the relationship going and more prosperous years ahead. So thank you so much.
Appreciate it. Thank you.